All right, so every day there's rumblings and differing perspectives and predictions on when we're going to enter a recession. And frankly, I think everybody expects us to enter a recession, which in of its own probably means we are going to enter a recession, right? Like if everybody expects it, it's probably going to happen because they'll make decisions, they'll pull back purchases and so forth, and then that will lead us into a recession. It kind of becomes a self-fulfilling prophecy. Today we're going to talk about whether or not investing in venture capital during a recession is a good thing or not. Is venture capital a good asset class during a recession? The first thing you have to understand is timing. Now, how is venture capital going to perform during a recession? It's going to differ based on when the fund was raised. And the reason for that is because funds go out and they'll raise money and then they'll deploy that money over the course of 10 years, essentially. So the typical path is a venture fund will raise, call it $100 million. They'll deploy most of that, 50 to 60% of that in the first 3 to 5 years in new companies. And then they'll reserve the rest for follow-on investments over the remaining 10-year period. What that means, though, is that if you raised your venture fund last year, you were probably deploying capital into companies that were overvalued, right? And now as valuations come down, you're going to see write-downs in valuation. Now, if you wrapped up your fund deployment cycle last year, right, you're kind of tapped out and done. On the other hand, if maybe you started investing last year, but you still have another 2 years, now what you can do is you can buy in at very low valuations, and hopefully the two kind of equal each other out. And so what you'll see is performance by vintage is what we call it. Will vary by year. So vintage is simply the year in which you raised money. My guess is that funds that raised money in 2000, well, probably 2019, 2000, 2001, will probably have somewhat subpar returns relative to the overall history of the venture ecosystem. Those funds that raised money in probably 2015, 2016, 2017, 18, they were probably able to post incredible returns because they invested early enough that those companies exited or went public during this last bubble that we saw where valuations were skyrocketing, and they probably did exceptionally well. So there's going to be some trade-offs there. The flip side is if you raise a fund right now, the advantage you have is that all of your investments, hopefully, if you do it right, are going to be relatively lower priced. And so as we come out of the recession, you should see good gains, assuming, you're a good venture investor and not overpaying in today's market. It's going to depend on when you raise that money and what impact it's going to have on your returns, what vintage, what year, right? But the really challenging thing is that right now is a really hard time to raise money, right? Frankly, now's one of the best times to raise money and to be investing. And it's also one of the hardest times because there's so much uncertainty and everybody's pulling back, right? This is the classic Warren Buffett phase, to be greedy when others are fearful and fearful when others are greedy. We all should have been fearful last year and we should all be greedy today. But that's just not the way human psychology works, right? You're watching your portfolio collapse. You're watching companies, valuations drop. They're doing more layoffs. There's all kinds of challenges. There's all kinds of uncertainty. And so you just kind of want to step back and see how things play out before diving back in. So that's one of the challenges, right? The other thing is that there are a lot of funds that raised money in the last few years that thought that they were geniuses, deployed a bunch of money into these overly priced companies, and now those companies are underperforming. Valuations are coming down. Some of them are really dependent on access to cheap capital. And when that capital dries up, they ultimately end up failing, right? And so the returns for those funds are going to go down. And my guess is that they're not going to have strong enough returns to be able to raise their next fund. One of the tricky things, though, about venture capital, like I said earlier, is that these are 10-year vehicles. And so if you're in year 3, year 4, and you just watch your entire portfolio get trashed, right, and you have a lot of losses and so forth, you're still going to be around for another 7 years. And what we call these zombie funds, because ultimately they don't have the ability to raise another fund, but they still have to sit around and manage their current portfolio of what's left. They can be challenging because VCs have a lot of ego. And so it can be tough to know, is this a zombie fund, right? Because they're willing to take a meeting with you, even though they won't invest. Or is this a solid fund that's going to survive this and actually write a check in my business? And so what I expect is you'll see VCs will keep taking lots of meetings, but they won't write as many checks because of uncertainty in the market, and also because they don't have any more funds to deploy and they can't raise a new fund. That's a lot of the things like to keep in mind in terms of venture capital and how recessions are going to impact it. The flip side to all of this is if you are into venture capital for the long haul, you'll probably end up being okay, right? If you put all of your eggs into one venture fund basket, right, that's super risky. But if you're spread out across the asset class, the next couple of years might be hard years in terms of overall performance, but coming out of this, performance should rise, right? And in fact, you've seen a lot of really great companies get started in recessionary environments. So Airbnb started during a recession, Venmo started during a recession, Uber started during a recession, during the last recession, and a bunch more. Because what's happening is you have a lot of these companies that have raised a lot of money, they've hired a lot of people, and now as they're facing headwinds, they're starting to lay off people. And those executives, many of them have built a ton of experience building product, acquiring customers, selling product, right? Raising money, all of those things, and they'll now go out and start their own businesses. And so now might be possibly the best time to be investing in venture capital, right? As there's this big reset. The one caveat that I'll add that you need to do to be careful of when investing in venture capital right now is that there is a delay in terms of valuations. Valuations are going to come down in private markets, but it's going to take time. And the earlier stage the company is, the slower it will take for these valuation changes to occur. Because, and this is both a positive and negative, if I'm investing in a seed stage company, I'm paying $3 million valuation or a $10 million valuation, but I believe that this is ultimately $1 billion company. The difference between 3 and 10 doesn't matter a whole lot, right? But if the valuation in the future, I think now just got cut in half to $500 million, right? Then it starts to have a little bit of an impact, albeit less than if I were in a Series A company or in a growth equity company, right? And so that's why you see this trickle-down effect. You also have founders that have been raising and operating their business over the last few years that have just seen valuations continue to rise and go up and to the right. And so their valuation expectations are a lot higher. And so they're going to look at the terms that venture capitalists are offering and scoff at them and say, well, we'll just wait, right? They might be in for a rude awakening. I don't think we ever get back to the valuations that we saw in 2021 and 2020. I think those were basically driven by both the pandemic and inflation. And as the Fed cuts inflation and we come out of the pandemic, those two driving forces will no longer exist. And that will push valuations back down to where they have been historically, right? We're going to go from SaaS businesses being valued at anywhere, like in some cases 100 times revenue to being valued more conservatively at like 6 to 10 times revenue, which is a massive drop. And that will slowly make its way through the entire ecosystem. So the punchline is be careful about if you're investing, be very careful at the valuations at which you are participating. And in some cases, if you have to walk away from a deal, it probably makes sense to do that so that you're not overpaying. We just actually did this where we looked at a deal, super interesting company, loved them, loved the founder, loved everything about it, but the valuation was just too high. And the founder had very different expectations around where valuation should be. And so ultimately we couldn't come to an agreement. And we just said, look, like amazing business, but given how markets have changed, the valuation no longer makes sense. And we walked away. Right. And I think that's the kind of discipline that VCs need to have if they're ultimately going to be successful. Hopefully this was helpful. There is some gloom and doom in venture capital, but ultimately I am super positive on the future. If you look at like all the amazing things that we enjoy today, a lot of them have been derived from companies that have raised venture money, right? And I think that will just continue to grow and develop and improve in the future. Anyways, if you enjoyed this, check out my other video where I talk about how inflation is impacting venture capital and how it's impacting both returns, fund performance, funding availability for companies, and so on and so forth. Thanks.